Okay, let's talk about a company called Arcosa. Since it was spun off from Trinity Industries back in 2018, it has spent billions of dollars to completely reinvent itself. I mean, it's gone from a pretty cyclical manufacturer to a full-on infrastructure powerhouse. But the market still seems kind of confused about what to make of it. So let's dive in and see if we can figure out what's really going on here. And that brings us right to the heart of the matter, the central puzzle for anyone looking at this company from an investment perspective. It all comes down to valuation. Why is this company, after all this work to reshape itself, still trading at a discount? That is the key we need to unlock. And I mean, when you look at the numbers, the difference is just stark. We're looking at enterprise value to EBITDA, which is basically a fancy way of saying what the market is willing to pay for a company's earnings power. You've got the big guys, the giants in construction materials like Vulcan and Martin Marietta, trading for around 19 to 20 times their earnings. And then there's Arcosa, sitting all the way down at 13 times. That's a massive discount, and it's the entire reason we're digging into this story today. To really understand that discount, you have to go back in time. You have to understand where Arcosa came from, because before this huge transformation, the company looked very, very different. Let's call it the old Arcosa. So the old Arcosa was what you'd call a classic industrial manufacturer. They made things like barges and parts for rail cars. Now, don't get me wrong, those can be good businesses, but they are incredibly cyclical. That means when the economy is booming, they're printing money. But when things slow down, orders just dry up and their earnings get super unpredictable. And if there's one thing the stock market hates, it's that kind of volatility. It punishes companies for it with a lower valuation. And this chart right here, it just perfectly illustrates the problem. Look at that old business mix. The transportation segment, the super cyclical part, was this huge piece of the pie. Meanwhile, construction products, the steady, reliable part of the business, was just a tiny little slice. Management saw this and they knew they had to do something dramatic. And that something was a massive, multi-year strategic pivot. I mean, they didn't just tweak the business around the edges. They basically took a sledgehammer to the old model and started building something brand new from the ground up. And this timeline shows you exactly how they pulled it off. Right after the spinoff in 2018, they went on a shopping spree. But look at the pattern here. They're buying aggregates and construction-focused businesses. ACG, Stone Point, Amerion. And just as important, in 2024, they sold off their cyclical steel components business. It was a crystal clear signal about their new direction. And it all led up to the massive Stavola deal. The scale of this whole thing is just staggering. All in, since 2018, Arcosa has spent $2.7 billion on acquisitions. Now, to put that into perspective, the company's entire market cap today is around $4 billion. They essentially bet the farm on this new vision. It shows you just how committed they were to leaving that old identity behind. You know, one of the best ways to think about this is that it's a classic private equity playbook just happening out in the open in the public markets. They're buying up smaller, often private companies in a really fragmented industry, in this case, aggregates, and they're rolling them up into a bigger, more efficient platform that hopefully the public markets will reward with a higher price tag. And this was the crown jewel. This was the cornerstone of the entire strategy. Nearly half of all that money they spent was on one single deal, buying Stavola Holding for $1.2 billion. This wasn't just another purchase. This was a company-defining moment. It instantly gave Arcosa a massive, high-margin aggregates platform right in the New York and New Jersey metro area, which just happens to be the biggest and most valuable market in the entire country. Okay, so after all that spending, all that strategic repositioning, what does the company actually look like today? It's time to meet the new Arcosa. The result is just crystal clear. Look at this new business mix. It's a complete flip of the old company. The stable, less cyclical construction products segment is now the dominant engine of the whole business, making up the vast majority of earnings. And that highly cyclical transportation business, it's now the smallest piece of the puzzle. And here is the financial proof that the strategy is actually working. The company's profitability, its EBITDA margin, has just exploded. It's jumped from under 16% to nearly 21%. Now, for an investor, this isn't just some small improvement. This is a fundamental change in the quality of the entire business. That leap represents a 390 basis point improvement. I know, that sounds like jargon, but it's massive in this industry. It means that for every single dollar of revenue Arcosa brings in, a whole lot more of it is now dropping to the bottom line as profit. Their profit engine has been totally supercharged. So let's pull all these threads together. What is the core argument for investing in Arcosa right now? Well, it's what Wall Street likes to call a re-rating story. This slide just lays out the bull case perfectly. It's night and day. The company has literally transformed itself from a highly cyclical, lower-margin industrial manufacturer into a less cyclical, higher-margin infrastructure company. The argument is really simple. The market should stop pricing it like the old company and start pricing it like a modern aggregates powerhouse. So the bull case really boils down to this. First, that big valuation gap we saw at the beginning, that should start to close as the market catches on to the new Arcosa. Second, it's perfectly positioned to benefit from all this massive, multi-year government spending on infrastructure. Third, hey, management has proven they can actually execute this plan. And finally, they are laser-focused on getting a good return on all that money they spent. It's even baked into how they get their bonuses. But, of course, you always have to look at the other side of the coin. The bear case argues that maybe that discount is there for a reason. The biggest risk is integration. I mean, successfully absorbing a deal the size of Stavola is a monumental task. It's not a sure thing. The company also took on a lot of debt to get it done, which always adds risk. And finally, while it's less cyclical, it's not totally immune. It still has businesses tied to things like wind towers and barges. Okay, so if you're watching this company, what are the key things you need to keep your eye on? What are the specific risks and the data points that are going to tell you whether the bulls or the bears are winning this argument? All right, let's break it down. There are 4 key risks to watch. Number 1 is that integration. Making that massive Stavola deal work is everything. Number 2, the broader economy. A big recession would still hurt them. Number 3 is that debt. The leverage is manageable now, but if earnings were to fall, it could become a real problem. And finally, there's policy risk. Their wind tower business really depends on government support for renewable energy, and that can change with the political winds. So this is it. This is your investor checklist. In every single quarterly report, these are the numbers that really matter. Is that super important construction products margin still growing? Is that debt ratio coming down like they promised? What does the backlog for future work look like? Is the company actually generating cash? And are they able to raise prices on their aggregates without customers running away? These are the metrics that will tell the real story. And that really leaves us with the final multi-billion-dollar question. Management has spent $2.7 billion betting that they can build a higher quality, higher growth company that deserves a much higher price tag from the market. But the market, it's still waiting to be fully convinced. The next few quarters are going to show us whether this massive bet finally pays off, or if the very real risks that come with such a rapid transformation were just too heavy to handle.